Welcome back, traders. In the previous segments, we covered the daily loss rules, and if you haven't already clicked it at once, you are missing out. But now we move from the daily battery to the absolute battery. I'm talking about the maximum loss rules, also known as your account stop loss, the lines that can't be crossed, not just for the days, but for the entire life of your accounts.
And this is where a lot of traders misunderstand how the rule works. They think, well, I didn't hit my daily limit, so I'm fine. But then a week later, they chip it away their account and suddenly liquidation.
The max loss rule is the last safety net. If the daily loss is your daily seatbelt, then max loss is your airbag. If that limit is hit, it means your account is deemed unsalvageable under your current trajectory and is closed immediately.
So what's exactly the max loss rules? Let's define it simply. This is the total maximum amounts that you are allowed to lose across all trades for the entire scales. If your equities, that is, your real-time capitals, including open trades, ever drops below a certain percentage of your starting balance, your account is gone, period.
And unlike the daily loss, which reset every day, this one doesn't reset. It's cumulative. You can lose 2% one day, 3% the next. And if your total across the line, it does it.
And the percentage limit depends on your package. It's typically either 3% or 10% of your initial balance, not your equity, not your profit, but the original number you started with.
Let's walk through concrete examples. Suppose you have an instant funding account with an initial balance of $50,000 and your max lot limit is 6%, which is $3,000.
That means your equity can never go below 107,000 ever. Doesn't matter if you make 1,000 yesterday, the total loss from your highest point back down to that threshold is that what matters.
And remember, this rule includes both closed losses and floating losses. So if you have lost 2,000 in closed trade and you have another 100, 1,000 and 200 floating in red, your equity is now 46,800. That's below the limit and account is closed.
And just to be clear, it's not about the net or loss across traders. It's about where your equity stands in real terms relative to that stop loss floor.
And where you in profit, here where it red get interesting and little tricky. Let's say your account grew to 51,000 currently, you in profit.
But the max loss limit is still based on your original 50,000 starting balance. So if your limit is 3%, the threshold is still 47,000. What changes is how much room you have to fall below you hit it.
Exactly. Now you have $4,000 in total buffer because $51,000 minus $47,000 equal $4,000. So your profits give you a cushion, but the floor never move.
Once your equity drops below that maximum loss threshold, even by a few dollars, other liquidation triggers on trades are closed immediately at market price.
And again, like with the daily loss, if there's volatility or slipback, your account might close out below that line. That's your execution reality.
And more importantly, once it breaks, the scale is permanently disabled. You will need to purchase a new package if you want to continue trading. No resets and no rollback.
Alright, let's get tactical. How do you actually trade inside this rule without constantly worrying about it?
First, check your total close losses every day. You should always know how close you are to your max loss floor. Don't wait the dashboard warning. Calculate it manually.
Second, use your profit as protection, not permission. Don't treat floating profit as a green light to increase risk. Instead, consider locking in gains by reducing loss size when you are ahead.
Third is manage your floating loss aggressively. Even if you are positive overall, a single trade with poor stop placements can take you from safety to shutdown in a few minutes.
4. Stay cool when you close. If you're down 5% out of your 6% limit, that is not the time to double down. That's the time to step away, pause, and retain your entry.
The biggest mistake, underestimating float drawdown. Traders go to loser and think, okay, I still got room, but they forget about the 4 trade floating minus 1800.
Second, trade who trade recovering after a bad day. They lose 4% in one day, come back to win the net. They thinking they will make it back and instead take another 2%, boom, violation.
Third, and this one hurts, ignoring slipback during major news. Even with a tight stop, new candle can get you straight to your limits.
The mark loss rule is there for a reason, not there for punish you. It's there to protect you from yourself. Every successful trader I know see their stop loss, whether personal, institutional, and non-negotiable without boundary.
Right, is a reality check. If you are consistently brushing up against your masters, the problem isn't the rule. The problem is your system or your psychology.
And as WeMasterTrade, we're not just giving capitals, we are teaching structures, and the max lot rules is what separates gamble from professional. So remember, your max loss is percentage of your starting balance, typically 6% or 10%. It's calculated using equities, not balance. It includes both close and floating losses, and once breaks, your account is gone. And coming up next, we will explore the consistency rules and why steady profits matter more than big spike when it comes to growing, scaling, and getting paid.
And if you have ever made 5,000 in one day, then made 200 in the next 4 days and wonder why your payout got flat, this next segment is for you.
Let's try into the rhythm of profitability and how to stay consistent under WeMasterTrade model.
Alright traders, we will talk about the daily loss limits and we just cover the maximum loss rule, two pillars to protecting your capitals. But now it's time to shift gear just a little and talk about not about rate but about the results. Because here things is not just about staying alive in the game. As WeMasterTrade, we want to see great trader growth, scales, and actually earn. And to do that, you need to more than just a winning days. You need something called profit consistency.
This rule right here, the profit target consistency, profit consistency rule is what celebrates the lucky buy from a reliable trader. It tells us whether you can make money over time, and or if you are just hoping to hit one big winner and roll the dice.
And more importantly, it's also how we evaluate if a trader is eligible for withdrawal, profit sharing, and even scale up. So if you're funded and you are all wondering why your payout didn't go through, this rule could be the reason.
So let's define it clearly. The profit consistency ratio is a measure of how even your profits are from day to day. The more balance of your profits, the lower your ratio. The less consistent, meaning you have one giant profit day and then smaller or losing days, the higher your ratio.
The idea is simple. If 80% of your total profit comes from one day, that's not consistency, that look or risk. What we want to see is trader who make profit day after day, even if it's small. That's what we can scale.
The formula is really straightforward. Take your best trading day's profit and divide by your overall profit since you started the account, then multiply by 100.
And the formula is best day divide total profits multiply 100 equal profit consistency percent.
And just to be clear, best day refers to your high close profit in a single calendar day, and total profit is a sum of all your close profit minus any close losses or open losses across the life of the account.
So let's say you have had the following results over 5 trading days. Day 1, $100, day 2, $200, day 3, minus 50, day 4, 100, and day 5, $60.
That means your total net profit across 5 days is 100 plus 200 minus 15 plus 100 minus 60 equal to 410.
And your best day was day 2, that $200 profit.
So now we apply the formula 200 divided to 410 equals 0.4878. Multiply that by 100 and you get a profit consistency ratio of 48.78%.
Now, let's say your account requires 20% profit consistency with e-commerce. This trader is about that, so they wouldn't qualify for a payout yet.
So even though the traders are profitable, they are not consistent enough. There has one big day that makes up almost half of their total profit. That's not sustainable, and that's we are looking at.
And this is where I really want to speak to traders. If you're relying on one or two big days to carry your entry account, that's not professional trading. That volatility, you can get lucky but you won't stay funded.
And remember, it's not just about your payout this week. WeMasterTrade evaluate your consistency over time. Traders who show long-term balance are the ones who get scale up, who get features, who get trusted with more capital.
Alright, so let's address the numbers. What is acceptance profit consistency ratio?
Typically, the rule is set at 20%. That means your best day should not exceed 20% of your overall profit. So let's say you are over the limit, don't panic, you are not disqualified. You just need to keep trading and even out the curve.
Here have to do that. Trade smaller size for a few days. Take smaller control win, aim for $200 or $300 days. Avoid big swing trader that goes by your ratio again. Spread profit across multiple days, not one month setup.
And those for those using EAs, monitor your equity curve. If your EAs is skewing profit heavily into one day, you might need to rebalance it. The box might be profitable, but it won't pass its rules unless it's configured with payout logic in mind.
So, some common mistakes to avoid. Mistake number 1, traders hitting target early, then taking the rest of the week up. That inflates your best day and leave the rest of your curve flat.
Mistake 2, over trading after a big day, thinking I'm safe now, and trying to squeeze more instead of averaging out that high total again.
And the last one, mistake number 3 is thinking this rule is just a hurdle. It's not. It's a reflection of what we actually look for in our master trading.
At the end of the day, this isn't about controlling you, it's about building habits that can handle scale. If you can be consistent with 25,000, what happens when we give you 100 and 100,000 or more?
Exactly, consistency is what makes yourself to invest in. At WeMasterTrade, we fund traders, but we also study them. This rule tells us whether you are serious about long-term trading.
And we've seen this times and time again. The traders who respect these rules, they are ones who get multiple payout, referrals, and grows into six-figure funded accounts.
So don't fear the rules, understand it, use it as a feedback tool. If your ratio is too high, great, that means you got profit. Now keep going and balance it out.
And remember, you don't need to calculate it manually. WeMasterTrade dashboard calculate your profit consistency ratio automatically. You can check it anytime under your static tick tab.
And to recap, this rule is about the balance, not volumes. And to keep your best day under 20% of your total profits, spread your wins across multiple sections and monitor your progress in the dashboard. We walk through the daily loss limits, tackle the maximum account loss, and examine how profit consistency set for long-term payout and growth. And now we will arrive the finals and perhaps the most overlooked rule of all, the risk consistency rules, or we call the skip like that.
That's right. Traders often think the big enemy is the market, but truthfully inconsistent, especially in how much you're risking from one trade to the next.
This rule doesn't look at how often you win, it looks at how stable your risk is and how professionally you are managing your position sizing. And if you're serious about scaling at WeMasterTrade, this rule is non-negotiable.
Let's break it down. As it scores, the risk consistency rules is simple. You are not allowed to risk more than 2% of your initial account balance on any single trade idea.
And that includes all losses across with that trade idea, both low losses and floating losses, even fee, commission, and swap are counted.
And for some accounts like the 51010 OBC package, this rule gets even stricter. There the limit is 1% per trade years, not 2%.
Because consistency isn't just about the outcomes, it's about the process. The more erratic your position sizing, the more volatile your equity curve becomes, and that makes you hard to scale.
And this rule protects both you and the firm. It helps reserve capital, prevent loss, equity swing, and make sure your egg plays out over time.
This is where it's technical, but stay with us. The term trade idea isn't just one other. This is a group of trade that share the same logic.
If you open three buy position on go at different time, that's one trade idea.
Because it's the same symbol, same direction, same close around the same time, even if you open them at different times, they are seen as a single, unified position from a risk perspective.
So the system doesn't look at your trades in isolations. It groups them into logical bundles and apply the 2% rules across the entire bundle.
You can have multiple separate trade ideas as long as each one respects the risk limit.
For example, if you go long on gold, short on GBP/JPY, and short on AUD/USD, and each position has its own distinct direction and assets. Those are three separate trade ideas, and each one can risk up to 2%.
Let's say you go buy on gold and you go buy against and against. You now have three open positions in the same directions on the same assets.
Yep, the system treats that as one trade idea, so if your combined floating risk or eventual loss from those positions exceeds 2% of your starting balance, boom, you have broken the rule.
And another mistake, opening multiple go buy, then closing one 10 minutes later, and two orders together. The system will group trade close within 3 minutes of each order, so be mindful your close timing.
Let's go hand on. Suppose you have a 100,000 accounts and the 2% mark risk per trade idea means you can't lose more than $1,000 on any trade idea total.
So you open two goals one lot is you don't buy set stop loss, new hit, market drop 100 pips, it's lot 1,000, that's 2,000 total.
You are right on the line. If slippage or swap adds a few extra dollars, that's it, rule broken. Account flagged or liquidated depending on the enforcement model.
And on some accounts, especially instant funding account with stricter tolerance, this breaks may result in loss of funded status or immediately closure.
So here is some pro tips to stay risk consistent. Tip 1. Set your lot size based on account risk. No, not emotion. Know how many pips equals 2%.
Tip 2. Use stop loss order religiously. Set them based on risk per trade idea, not random chart level.
Tip 3 is don't stack trades without calculating combined risk. Just because one position is below 2% doesn't mean risk of them are.
Tip 4. Label your trade ideas mentally. If you're entering on the same setup, treat it as one. Size it accordingly.
Tip 5. If you want to split an idea into multiple entries, do it smart, scale it smaller. Use micro lot if needed. Keep the total exposure below 2%.
So the most common reason traders break the rules, stacking multiple entries on one trade's idea, thinking is still separate.
Second, opening high risk trade after win, assuming they playing with a house money spoiler. The market doesn't care.
And the third is neglecting floating loss. Our trades may not be closed, but the floating risk still count toward your 2% risk.
And this is just policy. This is a professional practice. Hedge fund allow it. Bank follow it. Real trader follow it.
Exactly, we are not here to micromanage you, we are here to protect your account, our capital, and the integrity of this community.
And traders who internalize these rules, who understand that small, consistent risk is the foundations of scalable capital. Those ones with growth, those are the traders who go from 25,000 to 1 million.
And if you want to be professional trader, you have to think like one. And professional trader also weigh now how much they risk on every trade every day.
And if you are still guessing your loss sign or opening trade because the setup feels right, take this as your sign, step it up, get structure.
And this more than the rules is a habit, build it now and the path to bigger capitals and longer payout become way more predictable. And that's, my friends, one of the 4 essential rules of trading that WeMasterTrade include daily loss, maximum loss, profit consistency, risk consistency, mastery. And you are not just in stay compliant, you are building a foundation for serious capital management, long-term payout, and scaling. And this is all about the packages, rules as WeMasterTrade. Now, alright traders, before we end this incredible sections, we want to bring the everything full cycles, because today's version is about telling you how WeMasterTrade works. It's about showing you that's what it means to trade with qualities, with capitals, and with confidence. Here is something trading news for today.
So hey traders, welcome back to the live session. It's Tuesday, August the 5th, and we got a jam-packed economic calendar today. So for the first event at 1 a.m. Learn USD Learn Officer Survey, we kicked off early with a Learn Officer Survey from the US. Why it's a low impact event on the calendar? It gives insight into lending standards and demand for loans, useful for those tracking credit growth or early signs of economic shift. At 6:50 a.m. TBY monetary policy meeting minutes. Next, we had the Bank of Japan's policy minutes. No major surprises here, but any hawkish still could influence in pair. Traders might be positioning ahead of future DOJ moves, especially with the yen being under pressure recently. At 8 a.m. New Zealand dollar ANZ commodity price, a drop of minus 1.8% compared to the previous minus 2.4%, still in negative territory though. New Zealand's economy is highly commodity driven, so few traders take note. Not a game changer, but it confirms some softness in global demand. At 8:30 a.m. AUD job advertisement, Australia saw a -1% drop in job ads compared to a previous increase of 1.6%. Weak labor signal like this might lead to RBA easing bias or at least some caution in the UC dollar. At 8:45 a.m. CNY Pricing Services EMI. Now this one was a positive surprise, 42.6 versus forecast 40.4 and previous 40.6. It signals solid expansion in China's service sector that gave a little push to risk sentiment in early Asian trade. So, in conclusion, for the tentative event, GBP 10-year bond auction, USD, RCM tip economic optimism, and New Zealand dollar GDP price index. These tentative events don't have fixed time, but keep an eye out. GDP in particular can influence New Zealand if it's surprise. So, the big story today, Europe's resilience, especially in services and French industrial production. Onshore U.S. services data holding steady keeps the Fed hawkish turn on the table, and China's pricing BMI surprise to the upside, giving global risk sentiment a small push. For traders, today's theme is stability with a touch of upside bias. And that's it for today's data rundown. Let us know in the chat what pair are you watching. And remember, trade smart, not hard. Set stop loss, set those stops, stay updated, and we will watch you in the next live section.
And that is for today's live streams. Thank you so much for tuning in, and goodbye and see you later.